Hello everyone, this is Elliot Gu here with the Free Market Speculator and the Energy Bulletin, and welcome to my Sunday Deep Dive. In this weekly video, we take a look at a key chart, trend, or indicator that caught my eye over the past week, and I explain what it means, or what at least I think it means, for markets. Now, if you open any major financial publication, or if you turn on financial television, CNBC today, you'll probably hear an endless, deafening chorus about the so-called energy transition, surging demand for electricity from AI data centers, and the strategic fight over semiconductor supply chains. But the mainstream media is completely ignoring one of the most asymmetric, under-the-radar trends in the entire macro landscape: the absolute intersection of global energy and food on your plate. Many look at a field of corn or soybeans or wheat and they see a weather play. I look at that exact same field and see a highly refined, brilliantly re-engineered cocktail of natural gas, petrochemicals, specialized mining infrastructure, and geopolitical trade agreements. This is not a new thesis for me. When I wrote about the convergence of food and energy sectors over 20 years ago in the Silk Road to Riches, the companies operating at the nexus of this cycle went on to deliver some of the highest absolute returns of any sector we tracked. Yet, because agriculture lacks the immediate flashiness of tech or even traditional oil and gas exploration and production companies, it is routinely left out of the broader financial conversation. That silence, well, it's your opportunity. Right now, a series of structural shifts ranging from deep supply chain squeezes to massive stealth exports of domestic US natural gas. They're completely reshaping the economics of the global food supply chain. To understand why a localized policy failure in Europe or a maritime flare-up in the Middle East can completely rewrite the profit margins of a domestic US farmer, you have to understand the chemistry and the infrastructure behind the input costs. So let's jump in with this. This table, it's based on data from the United States Department of Agriculture, USDA, and what it actually shows is essentially a profit and loss statement for a US-based corn farmer. This is the national average data for the US. Now, all of these numbers are expressed in US dollars per planted acre, and it's based on last year's crop, 2025. So you can see that last year, a farmer producing corn generated about $779.80 per acre from the grain itself, and another $2.63 per acre from secondary product. A good chunk of that is silage, essentially using the entire corn plant itself to create a form of animal feed. At any rate, the total there is $782.44 an acre, planted in corn, and that's in gross proceeds. Now, what I really want to focus on here is the operating costs. These are cash operating costs. And if we add them all up, we get to $440.11 per corn acre. Now that leaves an operating profit of $342.33 per acre, and that's just that gross proceeds figure, $782.44, less those $440.22 in operating costs. Now, the three largest operating costs for this corn producer are fertilizer, seed, and chemicals. And as I've called out here on this slide, these add up to 72.45% of the total operating costs for producing corn, almost 3/4. And corn is the most important field crop in the United States. Now look at soybeans. Same data, same presentation in dollar per acre terms, dollar per planted acre terms for last year, 2025. So the gross value of production per acre is $562.15, and that's less value per acre than corn. However, the costs here are also significantly lower than corn at $244.80. And look at the mix here. The same three operating cost lines: seed, fertilizer, and chemicals, which I've called out here, they're the same three largest operating costs for beans as they are for corn. However, for soybeans, these three line items add up to 67.5% of the total operating costs, which is less than corn at 72.45%. You'll also notice that for the 2025 crop year, based on these estimates from USDA, the operating profit per planted acre of soybeans was less than for corn at $317.35. So let's look at a summary slide here showing the relative importance of these three main operating cost line items. So again, that's seeds, fertilizer, and chemicals for three key crops, right? Corn, soybeans, which we just looked at, and I'm adding in wheat here. And this is both the winter and spring wheat crops sort of cobbled together. What's interesting here is just how much more important fertilizer costs are for corn and wheat, okay? Both in that 36% to 38% of total operating cost region relative to soybeans at 22.3%. Now at this point you might be wondering, what exactly are these fertilizers and chemicals being applied to these crops? So here are the main fertilizers presented on this slide. Now first up is nitrogen fertilizer. Nitrogen is just an element with the symbol N, obviously. And here we see the first energy linkage to food. The foundational building block for nitrogen fertilizers is ammonia, which has the chemical symbol NH3. In the US and most markets, natural gas is used to make ammonia. Now natural gas is methane with the chemical symbol CH4. So basically what happens is that the methane is stripped of its hydrogen atoms, and that hydrogen is combined with nitrogen in the air to create ammonia. That ammonia then is converted into nitrogen fertilizers like urea and ammonium nitrate. The important thing to understand, however, is that the cash cost of producing nitrogen fertilizer, well, it's roughly 70 to 90% based on the cost of that natural gas feedstock. Now, one point to understand is that China doesn't have the abundant, cheap natural gas supply that the US does. However, it does need massive quantities of nitrogen to feed its own crops. So China actually gasifies coal to produce nitrogen fertilizer. 75 to 80% of China's ammonia production is produced using coal gasification technology. In fact, every year, China consumes 100 million metric tons of coal only as feedstock to produce nitrogen fertilizer. So let me put that figure into perspective for you. China consumes an amount of raw coal just as chemical feedstock for fertilizer that is equivalent to more than 1/3 of the entire physical coal volume burned by all countries in the European Union for all purposes combined. If we add in the coal used to generate power and energy to run those very same Chinese fertilizer plants, then China's total process demand for fertilizer, well, it jumps up to around 150 to 200 million tons a year, which represents closer to 2/3 of total EU coal consumption. And consider this, the entire United States, with its vast power grid, industrial manufacturing, and massive new AI data centers, well, it burns roughly 400 million metric tons of coal a year. China's chemical plants consume nearly half that entire amount just to power and supply feedstock to the facilities that manufacture nitrogen fertilizer alone. So let's move on to the second big fertilizer, phosphate, or really phosphorus pentoxide, a molecule with the chemical symbol P2O5, to be exact. Now, phosphate is a mine product. And here in the US, my home state of Florida, where I'm sitting right now, it's the undisputed king, accounting for 60% of total US production and around 1/4 of global phosphate supply. Now, it's mainly from an area known as the Bone Valley. Now, here's a map of Florida so you can get an idea of where that exactly is located. However, there is a huge catch for phosphorus fertilizer. You see, plants can't process raw phosphate rock, such as that mined in this state. It's insoluble in water. So the fertilizer industry relies on sulfuric acid to break down the raw rock. Now, sulfuric acid has the chemical symbol H2SO4, and you'll notice that there's sulfur in there, right? Now, this is crucial. It takes 2.8 tons of sulfuric acid to produce a single ton of phosphorus fertilizer. And here's a chart of sulfur prices over the past 5 years. Now, if you look at the global benchmark chart provided by Trading Economics here, you can see that the contract, which is priced in Chinese yuan per ton, this is an Asian contract, well, it's gone completely vertical. As I said, this is a key Asian benchmark for sulfur pricing. And it's at around 750 7,550 which is about $1,040 per metric ton. So why have sulfur prices shot up so much this year? Well, just consider that the main source of sulfur all over the world is the global refining and natural gas processing industry, right? Specifically, when a refiner processes sour crude oil, they remove sulfur prior to creating usable products like gasoline and, get this, ultra-low sulfur diesel fuel. Indeed, the term sour, well, it just means oil or natural gas that has a lot of sulfur in it, as opposed to sweet crude that's low in sulfur. Now, to be specific, sour oil is defined as oil with more than 0.5% sulfur content. The Gulf Coast's highly complex refineries have the capacity to refine sour oil. Not all refineries in the world do. Indeed, the US produces around 8 million metric tons of elemental sulfur per year, mostly recovered from US refineries. However, there's an important mismatch here, and it actually relates back to a video and a post I produced regarding Venezuela early this year. Now, I'll link to that video in the text below for those of you who might have missed it. The issue is that the US mainly produces light, sweet crude oil. Shale fields like the Permian produce sweet crude oil. And there's been a steady decline in US heavy and sour crude oil production for many years now, even as the shale revolution turned the US into the world's largest producer of oil. Now, light sweet crude oil is the higher value product generally. It's easier to refine into usable refined products like particularly gasoline. However, US refineries were built up long before the shale boom years, and so they're actually tuned to most efficiently run a mix of light sweet crude oils and heavier and more sour crudes. They're tuned for that. That's why that narrative we heard earlier this year about Venezuelan oil being some sort of thick gunk, that sludge that no one wanted, why it was so silly. US refiners would love easier access to heavy Venezuelan barrels because it helps them optimize their operations. Well, soaring sulfur prices are another piece of the same puzzle. US light sweet crude oil generates little sulfur to make phosphorus fertilizer. Instead, that's going to come from Canada's Western Canadian Select crude, right, which is about 3.5% sulfur. Or other sour crudes like Mexican Mayan crude, and yes, Venezuelan Mary oil. Some of these benchmarks have up to 3.5%, 3.8% sulfur content. A lot of people think sulfur is just a pollutant, but it's not. It's crucial to keeping America's farm belt productive, as well as for the entire global agriculture industry. Now, outside the Americas, much of the world's sulfur supply comes from, you guessed it, the Middle East. Iraq produces a lot of heavy sour crude oils and has an actual dedicated sulfur mine as well. Also Kuwait, Saudi Arabia, and Qatar. So that's why the closure of the Strait of Hormuz has impacted the price of sulfur and the cost of food production, as well as the price of oil and gasoline. When shipping lanes in the Middle East face closure risk or insurance premiums go vertical, that massive flow of merchant sulfur chokes. International buyers frantically scramble to outbid each other for whatever alternative tons they can find, sending global prices skyward and leaving localized processing operations everywhere exposed to the risk. So even in the US, where access to supply is less of an issue than, for example, an import-dependent Europe, there's been a big surge in sulfur prices this year that's raising the cost of phosphate fertilizer. So let's go back to this slide, and let's skip forward to the final fertilizer here quickly. Now that's sulfur itself. Now the problem here is actually kind of fascinating because it's an unintended consequence of the 1990 US Clean Air Act. You see, until the 2000s, most US farmers didn't have to apply sulfur directly because US coal-fired power plants release sulfur dioxide into the atmosphere. That's what causes acid rain. However, as coal-fired plants started installing scrubbers to remove sulfur from their emissions, and the nation began switching from coal to gas-fired power plants, atmospheric concentrations of sulfur dioxide actually dropped so much that sulfur now has to be applied as a fertilizer in the United States. You see, in the 80s and 90s, it's been estimated that sulfur dioxide in the air resulted in 10 to 15 pounds of pure and free sulfur per year, per acre rather, per year per acre of land in the United States. But that's now dwindled to less than 2 pounds per acre. So that's now a cost for US for farmers. And as I just explained, the supply of sulfur is directly tied to the global oil refining industry. Now, the final nutrient I want to discuss here is potash, measured globally by its potassium oxide equivalent content. Now, this is a purely mined commodity. The US gets most of its potash from Canada, where it's shipped via rail directly down into the heart of the American agricultural heartland or belt. Outside Canada, though, global supply is dominated by Russia and Belarus, okay? This caused a massive spike in potash prices back in 2022 when Russia invaded Ukraine, fueled by fears of a permanent supply loss. But instead, a massive trade rerouting took place. Most of that sanctioned supply is now simply shipped to China via rail, or it's loaded onto ships, ocean-going ships, bound for distant agricultural powerhouses, particularly Latin America. So Brazil and Argentina being two big importers. Now, Europe in particular took the brunt of this shock, right? Prior to the war, they relied heavily on Russia and Belarus for potash. Europe chose to impose punitive sanctions on that supply. Sanctions they are strictly maintaining into 2027, even as the US has recently started rolling back its own restrictions to ease global market pressures. Now, the result of this, European domestic agriculture has been squeezed incredibly hard. But here's the ultimate sort of ironic twist. To offset food insecurity anxieties, right, the US just provisionally enacted its massive trade agreement with Mercosur this May. Yes, those exact same Latin American countries that are successfully importing the cheap Russian and Belarusian potash to grow their crops. So look at the board here, right? The EU is effectively bankrupting its domestic farmers on fertilizer costs. Well, they turned around and signed a deal to import the food grown with the exact same sanctioned potash they banned and made it easier for foreign producers to undercut European markets. They are increasing the region's import dependence, raising baseline food costs, and decimating higher quality domestic production. You can't make this up. You know, I guess it's no wonder French farmers were out spraying manure on government buildings earlier this year. At any rate, I suppose the good news for potash supply outside the EU anyway is that because potash doesn't require an intensive chemical synthesis loop or a chemical acid step like phosphate fertilizer, its processing relies primarily on standard electricity costs and diesel fuel to run mining equipment and conveyor belts. But that makes its cost structure somewhat insulated from natural gas and oil price volatility and what's going on in the Strait of Hormuz right now. So here's a quick chart from Eurostat, which provides official EU, European Union, economic and market data on many different areas of the economy. In this case, we're showing the prices of nitrogen, phosphorus, and potash fertilizers in euros per metric ton since early 2019. You can clearly see the big spike in 2022 amid disruptions caused by the Russian invasion of Ukraine and the subsequent loss of cheap natural gas supply from Russia. Now, the EU did get a respite in 2024 and 2025 due in part to favorable weather that helped reduce EU gas consumption and resulted in a bumper wheat crop last year. However, the European energy and related food crisis wasn't over. It was really just hibernating. And with EU gas storage at dangerous levels right now, coupled with the loss of Middle Eastern supply, you can already see the start of a new crisis there on that chart. However, let's back up and go back to this slide. 36.1% of the per acre operating costs for corn production in the US are tied to fertilizer prices, 22.3% for beans, and 37.8% for wheat. So there is a very real and very direct link from energy prices, oil, natural gas, and the Strait of Hormuz, to the cost of agricultural staples like corn, soybeans, and wheat, and of course, by extension, beef, poultry, and pork prices. I think you can also start to see how these forces have varying impacts on different crops, such as soybeans, relative to corn or wheat, and the different regions of the world, such as more supply advantaged US compared to the European Union. And the link stretches far beyond just fertilizers. Notice in particular that a sizable cost chunk for all these crops is allocated to chemicals. So what exactly does that mean? Now it's all presented on this chart that features data from USDA based on a survey of farmers for different crops. This first slide I'm putting up here shows you chemicals applied to US soybean and corn acres in the 2023 and 2021 crop years respectively. This is the most recent data we have for each crop. It's based on a USDA survey. You might be surprised to see that US farmers actually don't apply much in the way of insecticides to either crop. Only about 21% of the US soybean planted acres get insecticides and 14% for corn. Now a lot of that has to do with new seed technologies introduced since the 1990s. In corn, for example, one of the most common pests is a corn borer worm. Now, if you're a home gardener, you probably know exactly what I'm talking about. But modern genetically modified corn seeds actually have a Bt trait in there. Okay, now Bt actually refers to Bacillus thuringiensis bacteria. When corn borers eat this bacteria, they immediately stop feeding and then they die. I actually have a bottle of it right here in my office. In this case, I just sprayed this Bt on my tomato plants as it works on those annoying hornworms that destroy your home garden down here in Florida. If you're a home gardener, you might even be familiar with this product, and it is considered an organic gardening tool here in the US. At any rate, you notice that the most important chemical type for both corn and beans, well, it's basically herbicides. These are weed-killing chemicals. And the most widely used herbicide is glyphosate. This is basically Roundup. Again, a lot of modern seeds produce corn and soybean plants that are designed to be resistant to herbicides like Roundup. As a result, you can spray the crop with herbicides, kill the weeds, boost crop yields without killing the corn or soybean plant itself. Also note some of the other chemicals here like atrazine, mesotrione, all right, acelytror. Here's wheat too, just so you can see that I'm not cherry picking on corn and soybeans. Well, guess what? A lot of these chemicals share something in common. They're all derived from methane, that's natural gas, petrochemicals, and natural gas liquids like ethane, propane, and butane. Formaldehyde is a key organic compound in many pesticides, and it's derived from methanol, which is synthesized from natural gas. Indeed, Expand Energy, the company formerly known as Chesapeake Energy, signed a 15-year deal to supply natural gas to the Lake Charles methanol project in Louisiana that will produce and export methanol. Assuming that deal gets a positive final investment decision from its developers, it would be ready to start exporting up around 2030. You also have triethylamine, which is built downstream from ethane. You have acrylonitrile, which is made from propylene. That's a byproduct of oil refining and often in the US synthesized using propane, which is one of the core NGLs. So there's yet another crucial link between oil, NGLs, and agricultural products. It's also another example of how a major strategic advantage for the US. After all, the abundant US shale gas, NGLs, and oil production that we have feeds those petrochemical plants on the US Gulf Coast. While the prices of these products are certainly influenced by global prices via exports, for commodities like natural gas and oil, the far lower transportation costs from the US Gulf Coast north to the heart of the US Farm Belt, well, it's a major durable competitive advantage. And from a supply availability perspective, well, it's a huge leg up as well. Think about what this actually means from a macro investment perspective, right? When the United States ships a cargo of corn, a vessel of domestic diammonium phosphate, DAP fertilizer, or a tanker of Gulf Coast methanol overseas, we aren't just exporting agricultural commodities. We are executing a massive stealth export of American natural gas and natural gas liquids, transformed into higher value chemical and biological products. While the media obsesses over standard LNG tanker counts and traffic, the real structural value creation is happening downstream, embedded directly inside the global food supply chain. When a farmer drives a sprayer across a field of Roundup Ready soybeans, they aren't just applying a farm chemical, they are spraying a highly refined, re-engineered cocktail of fossil fuels. Every single molecule of glyphosate requires natural gas to build its core, refinery olefins to build its frame, and phosphorus to give it power. If you shut down the oil refineries and turn off the gas pipelines, the modern weed control systems that underwrite global food production, well, they instantly evaporate. As I said at the beginning of this video, the global agriculture industry is a huge, complex topic, and it represents an enormous opportunity for investors in my view. It's clearly far too much ground to cover in just a single deep dive video like this. While today's video has barely scratched the surface of the topic, we did cover some significant ground, I think, including a rundown of the key underappreciated link between energy prices, agricultural input costs, and global food prices. How geopolitical events such as the closure of the Strait of Hormuz and even a potential expansion of Venezuelan oil exports to the US, how that can impact the agriculture industry specifically. Why vast US shale oil and gas resources and complex refining capacity don't totally insulate American farmers from these cost pressures, but undeniably give them a huge structural, durable advantage over farmers in regions like Europe or even Asia. A bit about the European Union's own goals, if you will, on energy policy, exacerbated admittedly by energy cost pressures, and why that's such a concern for the region's agriculture industry. Also, while most investors I talk to recognize the potential for US LNG exports and rising demand for electricity to power AI data centers, both as drivers for US gas prices, US exports of methanol, nitrogen fertilizer, and yes, even crops like corn and soybeans also represent stealth exports of US natural gas most investors in the media ignore. In an upcoming issue of the paid tier of this service, I'll be covering some specific stocks tied to some of these profitable trends in agriculture and the nexus of agriculture and energy. I am offering a free 30-day trial to the paid tier of this service to new readers who sign up for the paid tier, and I'll drop a link to that offer below. I'd also like to know what you all think of this topic, as I'm considering devoting one of my weekly Sunday deep dive videos each month to agriculture-related themes, because I see it as a very profitable and kind of under-the-radar trend that far too many people ignore. I certainly have a lot of ideas for future topics. Some of them include, how the relative fertilizer and chemical requirements of different crops, soybeans, corn, etc., drive farmer choices in terms of allocating acreage to those different crops, right? Why Europe's splits, in particular what the French call the troisième apport, has me so worried about the EU soft wheat crop this year. Why I think we'll see a significant bull market in the grain complex over the next few years. How the global agriculture boom relates to Germany's ongoing deindustrialization. And if you think this strategic advantage stops at the US border, wait until we look across the Pacific in a future video. We're going to dive into how Asian industrial powerhouses are positioning themselves downstream from the American wellhead. Take Japan, whose largest energy and trading conglomerates just partnered on a massive $4 billion nitrogen facility right in Louisiana to convert American natural gas into low-carbon ammonia fuel for their domestic power grid. Or look at South Korea, which has been importing record-breaking volumes of US grain to fuel their own booming global food processing and instant noodle export empires, to be exact. This isn't just a localized farm story. It is a global, multi-billion-dollar game of resource dominance, where the US Gulf Coast has become the ultimate anchor for all this. So let me know if you think these are interesting topics to cover, or drop me a comment if you have any other topic ideas or questions about this, or any other topic that I can competently cover. I also appreciate if you drop me a like and subscribe to get these weekly videos for free every Sunday afternoon if you haven't already. Again, thanks for listening. I'll be back next Sunday with a new deep dive.